Welcome, curious minds, to the deep dive. Today, we're embarking on a mission to demystify something that often feels like a secret language, the financial numbers of a company. Imagine you're a detective, right? And these numbers, they're your clues. We're going to try and transform what might seem like dense, really intimidating financial statements into clear, compelling narratives that tell you a company's true story.
Yeah, absolutely.
Forget about feeling overwhelmed. We're here to give you, hopefully, the shortcut to seeing a company's health, its hidden strengths, and maybe its lurking weaknesses too.
That's right. Because financial statements aren't just for, accountants or finance whizzes. They really paint a vibrant picture of a company's journey,
Yeah,
its triumphs, its challenges, and its future potential.
exactly.
So today we're equipping you with two incredibly powerful diagnostic tools. Ratio analysis and variance analysis. We'll be sifting through the real-world data, well, fictional data, but realistic data
All right, from J Company.
from G Company and then later Neostar Corporation to see these concepts in action and truly decipher what their numbers are, well, whispering to us.
Okay, so our mission for this deep dive is pretty clear. Take these complex financial concepts, specifically ratio and variance analysis, and really break them down into understandable, actionable insights. By the end, the idea is you'll be able to quickly assess a company's performance, its profitability, liquidity, solvency, all those key areas.
Yeah, the big picture.
Exactly. We want to transform those intimidating statements into clear narratives, helping you become well-informed with some maybe surprising facts and practical applications that really hit home. So let's kick things off with financial ratios. What exactly are they? And I guess why should anyone outside of a finance department really care about them?
Okay, good question. At their core, financial ratios are simply quantitative relationships, just connections between specific items you find on financial statements.
Like sales compared to profit,
Yeah.
or assets compared to debt.
Precisely. Think of them as highly concentrated insights. Instead of poring over hundreds of lines on a balance sheet or an income statement, a ratio sort of distills all that complex raw data into a single, usually easily digestible indicator of a business's health.
Ah, okay. Like boiling down a huge report into one key headline.
Exactly. It's like boiling down a massive report into one critical headline. Their core purpose is simplification and, crucially, comparison.
Comparison, right.
And that's why they're invaluable for, well, really anyone interested in understanding a company. Whether you're an investor looking at a stock, or maybe a potential lender assessing a loan application, or even just someone trying to make sense of business news.
Yeah, like when you hear a company's earnings report.
Right. These ratios provide immediate, insightful context. They give you a quick, digestible snapshot that lets you ask informed questions. It's not about crunching numbers aimlessly. It's about extracting meaning.
And you mentioned comparison, so what makes them powerful isn't just the number itself, but how it stacks up against others, is that right?
Yeah, absolutely. That's key. A single ratio in isolation, it tells you very little, honestly. Its true power comes from comparative analysis.
Also.
Well, you can track a company's own ratios over different periods, looking for trends year over year. Is their efficiency improving or declining? That's horizontal analysis, essentially.
Okay.
Or you can compare them against competitors in the same industry. How does their profit margin stack up against their main rival?
Right, or against the industry average.
Exactly, or against broader industry averages. These comparisons are vital because they reveal important trends. They tell you whether a company is outperforming, underperforming, or maybe just moving with the tide. It's like getting a health checkup,
Okay.
but also seeing how your numbers compare to others in your age group and how they've changed over time. It adds that crucial context.
That makes sense. It's not just, is this number good, but is it good compared to?
Precisely. And to help us organize these insights, we generally group financial ratios into 4 high-level categories.
Okay, what are those?
First, we have profitability ratios. These measure the success or sometimes failure of an enterprise in generating earnings. How good are they at making money?
Makes sense.
Second, liquidity ratios. These assess a company's immediate ability to pay its short-term bills. Can they keep the lights on day to day?
Crucial.
Third, solvency ratios. These look at the company's long-term financial stability. Can they meet their long-term debts? Are they built to last?
The big picture stability.
Right. And finally, performance metrics. These offer a broader view, often from an investor's perspective, touching on operational efficiency and how the market values the company. Things like earnings per share fall in here.
Okay, that structure helps a lot. Profitability, liquidity, solvency, performance. It's like having different lenses to view the company's financial story, from short-term survival to long-term growth and market view.
Exactly. Different angles on the same subject.
Okay, before we dive into specific ratios using G Company's numbers, there's something here called a pass key for understanding how changes impact ratios.
Mm.
You mentioned this is like a secret decoder ring. Sounds useful.
It really is. This pass key is fundamental for quickly analyzing scenarios, especially, in exams or just when you're thinking on your feet. When you're trying to figure out if an event will increase or decrease a ratio, remember these two simple rules about the numerator and the denominator, the top and bottom parts of the fraction.
Okay, lay it on me.
First, the numerator, the top number, has a direct relationship with the ratio.
Direct relationship, meaning?
Meaning if the numerator increases and the denominator stays the same, the ratio itself will increase.
Okay.
Think of a pie, right? If you increase the amount of pie, that's the numerator, but keep the number of eaters the same, the denominator, each person gets a bigger slice.
Right, more profit, same sales, higher profit margin.
Exactly. Numerator up, ratio up. Simple.
You got it. Rule 1 was rule 2.
Second, the denominator, the bottom number, has an inverse relationship with the ratio.
Inverse, so the opposite.
Correct. If the denominator increases, but the numerator stays the same, the ratio will decrease.
Okay, back to the pie.
Back to the pie. Same amount of pie, numerator, but now you invite more eaters,
Yeah.
denominator increases. What happens?
Everyone gets a smaller slice.
Precisely. So if a company generates the same amount of sales, numerator, but does so using a much larger base of assets, denominator increases, its asset turnover ratio will decrease. Denominator up, ratio down.
Numerator direct, denominator inverse. Okay, those analogies make it click. But what about when both the numerator and denominator change at the same time, or things get more complicated? That sounds like where it gets tricky.
That's exactly where it gets really interesting and often intuitively difficult. When both parts of the fraction are moving maybe in different directions or by different amounts, the final result isn't always obvious.
Yeah, I can see that.
So the best way to approach these situations, and honestly, this is a fantastic aha moment for a lot of people learning this stuff, is to simply make up easy numbers and plug them into the ratio formula.
Really. Just make up numbers.
Yeah, keep it simple. Say a ratio is AB and it starts at 105 equals 2. Now imagine something happens that increases A by 2 and increases B by 2. What's the new ratio?
10 plus 2, 5 plus 2,
Yep.
12, 7, which is less than 2. About 1.7. So the ratio went down.
Exactly. See, you create a simple, plausible scenario, apply the change, and just see what happens to the calculation. This practical trick turns a potentially complex theoretical problem into a straightforward arithmetic one. It gives you immediate clarity and confidence in your analysis. It's an invaluable mental shortcut.
That is useful. Like a quick reality check. Make up numbers and plug them in. I like it. All right, armed with our ratio mechanics and that cool plug in the numbers trick, let's dive into the first category. Profitability. We're asking fundamentally, how successful is this company at actually making money? Let's start with gross profit margin. What does this one tell us?
Okay, gross margin. This is a really fundamental measure of a company's efficiency right at its core, producing or buying what it sells. The formula is sales net, cost of goods sold, sales net.
So sales minus the direct cost of making those sales divided by sales.
Exactly. It reveals the percentage of revenue that's left over after you deduct only the direct costs associated with producing or acquiring the goods that were sold. Think raw materials, direct labor for manufacturers, or the purchase price for retailers.
So it's before things like rent, marketing, salaries for admin staff.
Precisely. It's your first look at how much money a company makes from its core product or service before any of those other operating expenses, interest, or taxes come into play. A higher gross margin often signals, strong pricing power or maybe excellent cost control in production.
Okay, let's make it real. Let's look at G Company here for year 2.
All right, G Company year 2. Their sales were $1,800,000. Their cost of goods sold was $1 million. So the gross profit is sales minus COGS, which is $800,000. Now, to get the gross margin percentage, we take that gross profit, $800,000, and divide it by sales, $1,800,000. That gives us, let's see, 0.4444 or 44.44%.
So what does that 44.44% actually mean for G Company?
It means that for every dollar of sales G Company generated in year 2, they kept about 44.4 cents after covering the direct costs of the goods they sold. The other 55.6 cents went to pay for those goods. That seems like a pretty solid margin, suggesting they might have decent control over production costs or perhaps healthy pricing for their products.
Okay, that's gross margin. Moving on, we have the overall profit margin. This feels like the one everyone knows, the bottom line number. What insight does this provide, especially compared to gross margin?
You're right, profit margin, often called net profit margin, is frequently seen as the ultimate profitability measure. The formula is simply net income sales.
Net income, so after everything.
Exactly. Unlike gross margin, which only looks at the cost of goods sold, the profit margin takes into account all expenses, the cost of goods sold, operating expenses like marketing and R&D, administrative costs, interest expense on debt, and taxes. Everything.
So it's the final score, really.
Pretty much. It tells you how much actual net income, the bottom line profit, a company makes for every single dollar of sales after every single expense has been paid. It's the true percentage of sales that converts into profit available for shareholders or reinvestment.
Okay, let's run the numbers for G Company in year 2. Their profit margin is.
Looking at their income statement for year 2, G Company's net income was $200,000. Their sales, as we know, were $1,800,000. So profit margin is $200,000 divided by $1,800,000. That comes out to 0.1111 or 11.11%.
11.11%. So for every dollar in sales, G Company pocketed about 11 cents as pure profit after all was said and done.
That's it. It's a comprehensive look at their efficiency from the very top line down to the very bottom line. It reveals how much of their revenue actually makes it through all those layers of expense to become profit.
Then there's another one here, return on sales, which looks at income before some things. Why do we look at this specific calculation? Income before income, interest expense, and taxes. Sales, net. It seems like a middle ground.
It is a bit of a middle ground, and it serves a specific purpose. This ratio, sometimes called operating profit margin if calculated slightly differently, gives you a cleaner look at a company's operational efficiency.
How so?
By stripping out interest income and expense, which relate to financing decisions, and taxes, which relate to the government's take, it isolates the performance of the core business itself. It helps us understand how well the company is generating profit purely from its day-to-day activities, which is critical for assessing how effectively management is running the actual operations.
Okay, so for G Company year 2, how does that look? The income before interest and taxes isn't listed directly, is it?
Not directly, but we can calculate it. Net income is $200,000. We need to add back income taxes, $103,030, and interest expense, $10,000. So $200,000 plus $103,030 plus $10,000 gives us $313,030 worse. That's income before interest expense and taxes. We divide that by sales, $1,800,000. Let's see, $313,030 and $1,800,000. That's roughly 0.1739 or 17.39%.
So G's core operations generated about 17.4 cents of profit for every dollar of sales before financing costs and taxes kicked in. That's higher than the net profit margin, obviously.
Yes, and comparing the two gives you a sense of the impact of financing and taxes on the final bottom line. A big gap might suggest high debt levels or high taxes, for instance.
Okay, now we're shifting slightly, looking at how efficiently a company uses its assets. Tell us about return on assets, ROA, and then this DuPont ROA. DuPont sounds fancy, like it has a story.
It does have a bit of a story, named after the company that pioneered its use. But let's start with the basic ROA. It's calculated as net income average total assets.
Average total assets, so beginning assets plus ending assets divided by 2.
Exactly. Using the average smooths out potential distortions from large asset purchases or disposals during the year. ROA is a critical metric because it tells you how effectively a company is using all its assets, cash, receivables, inventory, equipment, buildings, everything to generate earnings. It answers the question, how much profit is the company squeezing out of every dollar of assets it owns?
Okay, let's calculate ROA for G Company in year 2. Net income is $200,000. What about average assets?
We need total assets from year 1 and year 2. End of year 2 total assets are $2,815,000. End of year 1 total assets were $2,750,000. So the average is $2,815,000 plus $2,750,000, two else about 0.0718 or 7.2%.
7.2%. So for every dollar of assets G Company employed on average during year 2, they generated about 7.2 cents in net income.
That's the interpretation. Now, the DuPont ROA is where it gets really insightful, as you said. This formula, developed by the DuPont Corporation back in the 1920s, I believe, breaks ROA down into its 2 key components, profit margin x asset turnover.
Okay, profit margin we already calculated, 11.11%. What's asset turnover?
Asset turnover is sales net average total assets. It measures how efficiently a company uses its assets to generate sales revenue. A higher number means they're getting more sales bang for their asset buck.
So DuPont ROA, net income sales,
Yeah.
X, sales average assets.
Exactly. Notice how sales cancels out mathematically, leaving you with net income average assets, which is the basic ROA formula. But the decomposition is the clever part.
Why? What does breaking it down tell you? This sounds like the fantastic aha moment you mentioned earlier.
It absolutely is, because if a company's ROA improves, the DuPont formula helps you understand why. Is it because they became more profitable on each sale, profit margin went up, or is it because they generated more sales volume from the same asset base? Asset turnover went up, or maybe a combination.
So it pinpoints the source of the change, better cost control or pricing versus better asset utilization.
Precisely. It provides a much deeper diagnosis. For G Company in year 2, we know their profit margin was 11.11%. Let's calculate their asset turnover. Sales, $1,800,000. Average assets, $2,782,500 equals 0.6469, or about 0.65 times.
Okay.
Now, multiply the two components. DuPont ROA equals 11.11% by 0.65 times equals 0.0722, or 7.22%.
Wow, that's almost exactly the 7.2% we calculated directly, just a tiny rounding
Well,
difference.
it confirms the math and highlights the power of this decomposition. For G, their ROA of 7.2% comes from a decent profit margin, 11.11%, multiplied by a somewhat low asset turnover, 0.65. It tells management that while their profitability per sale is okay, they might need to focus on using their assets more efficiently to generate more sales volume.
This next one sounds really important for investors, for the owners of the company. What is return on equity in ROA?
Similar structure to ROA, but using equity instead of assets in the denominator. Exactly. And remember, equity represents the shareholder's stake in the company. So ROE measures how much profit a company generates for each dollar of shareholders' equity invested. It's a critical gauge of how well management is using the money invested by the owners to create value. A higher ROE generally indicates more effective deployment of shareholder capital.
Let's calculate it for Gee Company. Net income is $200,000. What's average equity?
We need total equity from year 1 and year 2. End of year 2 equity is $1,470,000. End of year 1 equity was $1,350,000. The average is $1,470,000 plus $1,350,000, 2 of $1,410,000.
Okay.
So ROE was $200,000, $1,410,000, which is about 14.11 cent, or 14.18%.
14.18%. So for every dollar of shareholder equity invested in G Company, management generated about 14.2 cents in net income during year 2. That seems pretty decent.
It's generally considered a respectable return, yes. Though again, comparison to industry peers and historical trends is crucial context.
We often hear the phrase, cash is king in business. So how do we measure a company's ability to generate actual cash from its operations to meet its short-term obligations? This feels very practical, very real world.
It is very practical. This is where the operating cash flow ratio comes in. It's calculated as cash flow from operations, current liabilities.
Cash flow from operations, that's from the cash flow statement, right? Not net income.
Correct. It's the actual cash generated or used by the core business activities found in the operating activities section of the statement of cash flows. This ratio specifically focuses on that operating cash generation and assesses the company's ability to cover its immediate debts, current liabilities, without having to rely on external financing like borrowing more money or issuing stock.
So how much cash are the operations generating relative to what's owed soon?
Precisely. For G Company in year 2, their cash flow from operations was $275,000. Their current liabilities at the end of year 2 were $695,000.
Okay.
So the ratio is $275,000, $695,000, which equals approximately 0.396.
0.396. What does that number mean? Less than 1.
It means G Company generated about 39.6 cents in operating cash flow for every dollar of current liabilities it had at year end. Generally, you'd want this ratio to be comfortably above 1, indicating that the company's operations are generating more than enough cash to cover its short-term debts as they come due. A ratio below 1, like G's 0.396, can be a warning sign.
A warning sign of what?
It suggests that the cash generated from operations alone might not be sufficient to cover all the upcoming short-term obligations. They might need to rely on existing cash reserves, sell assets quickly, or secure additional financing to meet those debts. It flags that G Company might need to manage its cash very carefully or improve its cash generation from operations. Okay, that operating cash flow ratio is actually a great bridge to our next category, liquidity ratios.
Right, you mentioned this earlier.
Yeah. While profitability tells us if a company is making money on paper, Liquidity is all about its ability to pay its immediate financial obligations, those current liabilities we just talked about. These ratios measure a firm's short-term financial health. Can they pay their suppliers next month? Can they make payroll? It's crucial for day-to-day survival.
So if profitability is about, the potential to make money long term, liquidity is about having enough actual cash or things easily converted to cash right now to keep the lights on and the business running smoothly. It's about immediate financial viability.
Exactly. It's about short-term financial viability and having the resources to meet obligations as they mature. An otherwise profitable company can fail if it runs out of cash.
So what's the most common liquidity measure?
The most widely known is probably the current ratio. It's calculated simply as current assets, current liabilities.
Current assets. So cash, receivables, inventory, short-term investments.
That's right. All the assets expected to be converted to cash or used up within 1 year or the operating cycle. The ratio gives a general indicator of short-term financial strength. It shows if a company has enough of these relatively liquid assets to cover its short-term debts. Generally, a ratio greater than 1 is preferred, suggesting current assets exceed current liabilities.
Okay, let's check G Company. Year 2, current assets are $715,000. Current liabilities are $695,000.
So the current ratio for year 2 is $715,000, $695,000, $695,000, and $695,000. $695,000 or $700,000. $700,000 RZ is 1.09.
So it dips slightly from 1.09 to 1.03. Still above 1, but is that good?
Well, here's where context is crucial. The notes mention the industry average equals 1.50.
So compared to their peers, 1.03 is actually quite low.
Exactly. The conclusion stated here is the ratio, and therefore G's ability to meet its short-term obligations, is low compared with the industry's average. This is a significant finding and a potential red flag about their short-term financial flexibility. They have less cushion than their competitors.
Okay, so the current ratio is a good general indicator. But what about this quick ratio, also called the acid test ratio? Why the need for a quicker or more stringent measure? What's the key difference here? It sounds more intense.
It is a more stringent test, hence the acid test name. The quick ratio is calculated as cash and cash equivalents plus short-term marketable securities plus accounts receivable net current liabilities.
Wait, so it takes current assets but subtracts inventory and maybe prepaid expenses.
Primarily inventory, yes. It excludes inventory and sometimes other less liquid current assets like prepaid expenses. The rationale is simple. Inventory isn't always quickly or easily convertible to cash. You have to sell it first, maybe discount it, and it takes time. Prepaid expenses won't turn into cash at all.
Right, you can't easily pay a bill with a pile of widgets or a prepaid insurance policy.
Exactly. So the quick ratio shows a company's ability to pay its short-term obligations without having to rely on selling off its inventory. It's a very conservative look at immediate liquidity, what assets are truly quick.
Let's calculate it for G Company. Year 2. We need cash, marketable securities, and accounts receivable.
Okay, year 2. Cash, $50,000. Short-term marketable securities, $75,000. Accounts receivable, $300,000. Add those up. $50K plus $75K plus $300K plus $300K equals $425,000.
Okay. Divide that by current liabilities, $695,000.
$425,000, $65,000, approximately 0.61.
0.61. That's below 1. How was it in year 1?
Year 1, cash $35K plus securities, $65K plus receivables, $390K equal $490,000. Current liabilities were $700,000. So every $100,000 is 0.770.
So it dropped here too from 0.70 to 0.61. And how does that compare to the industry?
The industry average is given as 0.80.
So again, G Company is lower than the industry average, and this time the ratio is below 1. That seems worrying.
It definitely reinforces the concern raised by the current ratio. A quick ratio below 1 and below the industry average suggests Jewel might genuinely struggle to meet its immediate cash needs if there were a hiccup in sales or collections, as they don't have enough truly liquid assets, excluding inventory, to cover current debts. It signals potential short-term trouble.
Okay, before we get into the next set of ratios, which are turnover ratios related to liquidity and efficiency, there's another quick passkey or reminder here. When calculating turnover ratios that involve an income statement item, like sales or cost of goods sold, and a balance sheet item, like receivables or inventory, you should generally use the average balance sheet amount in the denominator.
Right, like we did for ROA and ROE. Beginning plus ending, divided by 2.
Correct. It better reflects the balance sheet level throughout the period that generated the income statement flow. However, the note emphasizes, Always read questions or instructions carefully, because sometimes year-end balances might be specifically requested for certain calculations, especially for days calculations. That small detail can significantly alter your result. Got it. Use average for turnover, but pay close attention if ending balance is specified, especially for calculating days. Critical detail. Okay, so let's get into these turnover ratios. They seem to measure how quickly a company is moving things through its system. First up, accounts receivable turnover. How quickly is G Company collecting its money from customers?
This ratio is sales, net, average accounts receivable, net. It measures how efficiently a company collects the money owed to it by its customers. A higher turnover number generally indicates quicker collection, which means better cash flow and potentially less risk of bad debts.
Let's calculate for G year 2. Sales are $1,800,000. Average accounts receivable, we need year 1 and year 2 receivables.
Year 2 AR is $300,000. Year 1 AR was $390,000. Average is $300,000 plus $390,000, $345,000.
Equals about 5.22 times.
5.22 times. What does that mean? They collect the receivables 5 times a year. Essentially, yes. It means, on average, their entire accounts receivable balance was collected and replaced about 5.22 times during the year. Now, to make that more tangible and easier to understand, we often convert it into days using the days sales in accounts receivable, or DSO formula. Here, we usually use the ending accounts receivable as per the note's caution. The formula is ending accounts receivable net sales net 365.
Okay, so the denominator sales 365 is like the average daily sales.
Exactly. Average credit sales per day, technically. So the formula tells you how many days worth of sales are tied up in receivables at the end of the period.
Let's do it for G, year 2. Ending AR is $300,000. Average daily sales are $1,800,000, $365 is $4,931.51 per day.
So $300,000, $4,931.51 gives us 60.83 days.
60.83 days. So on average, it takes G Company just over 2 months to collect the cash after making a sale on credit. Is that good or bad?
Again, context is key. You compare it to their stated credit terms. For example, if they offer 30-day terms, 61 days is slow, and to industry norms. A longer collection period ties up cash that could be used elsewhere.
Okay, what about inventory? How quickly is G Company selling its products? This must be a huge factor in their cash flow cycle, especially given that low quick ratio.
Indeed. Inventory turnover measures this. It's cost of goods sold, average inventory. Note we use COGS here, not sales, because inventory is typically valued at cost on the balance sheet, so we want a cost-to-cost comparison.
Makes sense. Compare apples to apples.
Right. This ratio measures how quickly inventory is sold or turned over. A higher turnover generally indicates better performance-efficient sales, less risk of obsolete inventory sitting around.
Let's calculate for G, year 2. Key GS is $1 million. Average inventory.
Yeah.
We need year 1 and year 2 inventory levels.
Year 2 inventory is $290,000. Year 1 inventory was $275,000. Average is $290,000 plus $275,000.
Yeah.
2 equals $272,500.
Okay, so $1,282,500
Equals about 3.54 times.
3.54 times per year. Seems maybe a bit low.
Well, let's convert that to days as well, using days in inventory. Similar to DSO, we use the ending balance here. Ending inventory, cost of goods sold, 365. The denominator is average daily cost of goods sold.
Okay. Ending inventory is $290,000. Average daily key GS is $1,365,000. Gives us $139.73 per day.
So $290,000, $2,739.73 gives us 105.85 days.
Wow, 105.85 days. So on average, G & Company's inventory sits on the shelf for almost 106 days, over 3.5 months before it's sold.
That's what the number suggests. And yes, that does seem quite long for many industries. It could indicate inefficient inventory management, slow-moving products, or perhaps overstocking. This ties up a significant amount of cash in inventory. Remember how we excluded inventory from the quick ratio? This long holding period shows why it's not very quick at all for G Company.
Yeah, 106 days is definitely not quick.
Yeah.
Yeah, we've seen how long it takes them to collect from customers and sell inventory. What about the other side, paying their own suppliers? Is G Company quick or slow to pay its bills? This must impact relationships and maybe their creditworthiness.
Absolutely. We measure this with accounts payable turnover, cost of goods sold, average accounts payable. We use COGS again as it's generally the largest driver of accounts payable. This measures how many times on average a company pays off its suppliers during the year. A very low turnover might suggest the company is stretching its payments, possibly due to cash shortages.
Let's calculate for J, year 2. COGS is $1,000. Average accounts payable need year 1 and year 2 AP.
Year 2 AP is $150,000. Year 1 AP was $125,000. Average is $150,000 plus $125,000. 2 equals $137,500.
Okay, so $1,137,500.
Equals about 7.27 times. And again, let's convert that to days using days of payables outstanding, or DPO. And in accounts payable, cost of goods sold 365.
Okay, ending AP is $150,000. Average daily QGS is $2,739.73.
So $150,739.73 gives us 54.75 days.
It's 54.75 days. So GG Company takes, on average, almost 55 days to pay its suppliers.
Correct. Now, whether that's good or bad depends. If their suppliers offer, say, 60-day terms, they're paying well within terms. If the terms are 30 days, they're paying quite late, which could strain supplier relationships. But comparing it to their collection period, 61 days, is interesting. They pay suppliers slightly faster than they collect from customers.
Okay, we have days to collect, DSO 61 days, days to sell inventory, days inventory 106 days, and days to pay suppliers, DPO 55 days. This next one, the cash conversion cycle, sounds like it pulls all these together. This must be the ultimate measure of working capital efficiency, tying all those timing aspects together.
It really is. The cash conversion cycle, CCC, is often seen as the ultimate measure of how efficiently a company manages its working capital. The formula is days in accounts receivable, DSO, plus days in inventory, days of payables outstanding, DPO.
So days to collect plus days to sell, days to pay.
Exactly. Think about it. It measures the average number of days from when a company pays cash for inventory, implicitly linked to DPO ending, until it receives cash back from selling that inventory, DSO. The inventory holding period is in the middle.
So it's the time lag between paying out cash and getting cash back in from the core operations.
Precisely. It represents the number of days a company's cash is tied up in its operating cycle. A shorter cycle is generally much better, as it means the company needs less financing to support its operations and generates cash more quickly.
Let's calculate GI Company's cash conversion cycle for year 2 using the numbers we found.
Okay, DSO was 60.83 days. Days in inventory was 105.85 days. DPO was 54.75 days. So
Yeah.
CCC equals 60.83 plus 105.85, 54.75.
That equals 111.93 days.
111.93 days. So on average, Jai Company has cash tied up in its operating cycle for about 112 days. That's nearly 4 months.
That sounds long, especially considering their liquidity ratios looked a bit tight.
It is a relatively long cycle for many businesses. It confirms that a significant amount of capital is tied up in inventory and receivables for an extended period. This limits their financial flexibility, makes them more reliant on financing, and underscores the potential liquidity pressures suggested by the current and quick ratios. Reducing this cycle time would likely be a major goal for G's management. Okay, moving beyond the immediate day-to-day picture provided by liquidity ratios, we now turn our attention to solvency ratios.
Solvency, this sounds more permanent.
In a way, yes. While liquidity focuses on a firm's short-term ability to pay its current bills, solvency is all about the company's long-term financial stability and its ability to meet its long-term debts and obligations. These ratios offer a measure of security protection for long-term creditors, like bondholders, and also for investors, indicating whether a company is financially structured to withstand economic challenges over the long haul.
So, if liquidity is about keeping the lights on tomorrow, solvency is about making sure the whole building doesn't collapse years down the line. It's about the structural integrity of the finances.
That's a perfect analogy. It really is about the structural integrity of the company's financial foundation. How much debt are they carrying relative to their equity base? Can they handle that debt load over the long run?
This first one sounds like it gets right to the heart of that, the debt-to-equity ratio. It sounds like it directly tells you how much a company relies on borrowed money versus its owner's money.
That's precisely what it measures. The formula is total liabilities, total equity. Remember, liabilities represent what the company owes to outsiders, creditors, while equity represents the owner's stake.
So higher ratio means more debt relative to equity.
Correct. A higher ratio indicates greater financial leverage, meaning the company is using more debt to finance its assets. From a creditor's perspective, a lower ratio is generally preferred because it suggests there's a larger equity cushion protecting their investment in case the company runs into trouble or faces insolvency. More owner money is at risk relative to creditor money.
Let's look at Gene Company. For year 2, total liabilities are $1,345,000. Total equity is $1,470,000.
Okay, so debt to equity, $1,345,000, $1,470,000, which is about 0.9.
0.92. So for every dollar of equity, they have about 92 cents of debt. How does that compare to year one?
In year one, total liabilities were $1,400,000 and total equity was $1,350,000. The ratio was $1,400,000, 1.04.
So the ratio actually improved, decreased from 1.04 in year one to 0.92 in year two. That's a positive sign, right? They reduced their reliance on debt relative to equity.
Yes, that's generally viewed as a positive trend, indicating a strengthening financial position or a move towards a less risky capital structure. Another closely related solvency metric is the total debt ratio, sometimes just called the debt ratio. This one is calculated as total liabilities, total assets.
Okay, so this compares debt to the total resources of the company, not just the owner's stake.
Exactly. It tells us the percentage of a company's total assets that are financed by debt liabilities. It provides a quick overview of how much of the company's asset base is effectively funded by creditors versus owners.
For G Company in year two, total liabilities $1,345,000. Total assets $2,815,000.
So the total debt ratio equals $1,345,000. $2,815,000 was about 0.48.
0.48, what does that mean?
It means that approximately 48% of G Company's assets are financed by creditors. Debt, the remaining 52% is financed by shareholders' equity. A ratio of 0.48 suggests a moderate level of financial leverage. Roughly half their assets are funded by debt. Then there's the equity multiplier. This is calculated as total assets, total equity.
Assets divided by equity. How is this different? It sounds related to the other two.
It is related. It's essentially another way to look at leverage. It shows how many dollars of assets the company has for every dollar of equity. A higher equity multiplier means more assets are being financed by debt, since assets, liabilities plus equity. This ratio is actually a key component in the DuPont framework for ROE, which breaks ROE down into profit margin x asset turnover x equity multiplier. It shows how leverage amplifies the return on equity.
Okay. So it connects back to profitability analysis too. Let's calculate it for G. Year two assets, $2,815,000. Year two equity, $1,470,000.
Equity multiplier, you have $2,150,000, $1,470,000.
Equity on assets, $2,750,000, $1,350,000.
Year one equity multiplier equals $2,750,000. $1,350,000 equals 2.04.
Exactly. They tie together and tell a consistent story about a marginal decrease in financial leverage we saw with the debt-to-equity ratio.
Exactly. They tie together and tell a consistent story about a marginal decrease in financial leverage for G Company in year two.
Okay, if a company has a lot of debt, as shown by these ratios, it usually means it has interest payments to make. How do we know if it can reliably cover those interest payments from its earnings? This seems incredibly important for lenders and for the company's survival.
You're absolutely right. This is a vital check, especially for companies with significant debt. The ratio for this is called the times interest earned ratio, or TIE. It's calculated as income before interest expense and taxes, interest expense.
Okay, so we use that income before interest and taxes figure again, EBIT, essentially. We divide that by the actual interest expense.
Correct. This ratio directly assesses the company's ability to meet its interest obligations using the profits generated from its operations before interest and taxes are deducted. It shows how many times over a company could pay its interest expense using its operating earnings. A higher ratio indicates a stronger ability to cover interest payments, providing a greater margin of safety for lenders and the company itself.
Let's calculate TIE for G Company in year two. We found their income before interest expense and taxes was $313,030. Their interest expense for year two was $10,000.
Right. So TIE equals $10,000 equals 31.30 times.
31.3 times. That sounds really high.
It is very high. It looks extremely strong for G Company. It means their operating earnings before interest and taxes were more than 31 times the amount needed to cover their interest payments for the year. This indicates a very low risk of defaulting on their interest obligations, which would be very reassuring to their lenders despite their moderate overall debt levels. Their profitability from operations is more than sufficient to handle their current interest burden. All right, now let's shift gears slightly into our final category, which we're calling performance metrics. These often have more of a focus on operating performance and stock performance, particularly from an investor's viewpoint. They go beyond just the core profitability and stability ratios, often delving into how the market perceives the company and how it performs specifically for its shareholders.
Okay, so maybe things you hear more about in the financial news or on investor calls?
Exactly. And first up is a big one, EBITDA. This acronym gets thrown around constantly. What exactly is it, and why do people seem to place so much importance on it? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's widely used, though sometimes controversially, as a proxy for a company's operational cash flow.
A proxy, so not exactly cash flow, but close.
Kind of. The idea is to get a measure of profitability from the core operations by stripping out several items. Non-operating expenses like interest and taxes, and also non-cash expenses like depreciation for tangible assets and amortization for intangible assets. The thinking is that this gives a clearer picture of the underlying operational profitability before considering financing structure, interest, tax jurisdictions, taxes, or past investment decisions and accounting policies, depreciation and amortization, which can vary widely between companies.
So it makes companies potentially more comparable on an operational level.
That's the main argument for using it, yes. It tries to isolate the results of operational decisions. There are two common ways to calculate it, which should give you the same number if done correctly.
Okay, what are they?
There's the top-down method, sales cost of goods sold operating expenses, but excluding depreciation and amortization included within those expenses, or the bottom-up method, which is often easier, net income plus income tax expense plus interest expense plus depreciation and amortization expense.
Let's try the bottom up for G Company year 2. Net income, $200,000. Taxes, $103,030. Interest, $10,000. What about depreciation and amortization?
Looking at the notes or cash flow statement detail, which isn't fully here, but let's assume we find depreciation was $30,000 for year 2. So EBITDA, it was $200,000 plus $703,030 plus $10,000 plus $30,000, $343,030.
Okay, and we should get the same top down.
We should. Sales, $S, QDS, other operating expenses, excluding D&A. We'd need the detailed breakdown, but yes, it should reconcile. The example notes show it does reconcile for both year 2, $343,030, and year 1, $308,030. It shows a healthy level of earnings generated before considering those specific items.
Okay, next is probably one of the most famous numbers in finance, often the headline figure when earnings reports are released. Why is earnings per share, EPS, so crucial, especially for common shareholders?
EPS is incredibly important because it represents the portion of a company's profit that is allocated to each outstanding share of common stock. The basic formula is income available to common shareholders, weighted average common shares outstanding.
Income available to common shareholders, so that's net income minus any dividends paid to preferred shareholders.
Exactly. Preferred dividends have priority, so you subtract those first. Then you divide by the average number of common shares outstanding during the period. EPS is a widely watched indicator of a company's profitability on a per-share basis. It directly impacts investor perception and, often, the stock's value. A higher or growing EPS generally signals a more profitable company, which can lead to higher stock prices or increased dividends.
For G Company in year 2, let's assume they have no preferred stock, so income available is net income. $200,000. The notes say they have 100,000 weighted average common shares outstanding.
Okay, simple calculation then. EPS equals 100,000 shares pays $2 per share.
$2 per share. So for every share of G Company common stock out there, the company generated $2 in earnings during year 2.
That's right. It makes profitability relatable on a per-share basis, which is how most investors track their holdings. Now, building directly on EPS, we have the price-to-earnings ratio, or PE ratio. This is a crucial valuation metric. It's calculated as price per share, basic earnings per share.
Market price of the stock divided by the EPS we just calculated. What does this tell us?
The PE ratio tells you how much investors are currently willing to pay in the market for each dollar of a company's earnings. It's a measure of market expectation and valuation. A high PE ratio often suggests that investors are optimistic about the company's future growth prospects and are willing to pay a premium today for those anticipated future earnings. A low PE might suggest lower growth expectations, higher perceived risk, or possibly that the stock is undervalued.
Let's calculate it for G Company. Their EPS is $2. The notes say their market price per share at the end of year 2 was $12.
Okay, so PE ratio is $12. $2 is equal 6.
A PE of 6. That seems quite low compared to what you often hear for tech stocks and growth companies, right?
Yes, a PE of 6 is relatively low in many market environments today. It could signal several things. The market might view G Company as a mature business with limited future growth potential, or it might perceive higher risks associated with the company, or potentially the market could be undervaluing the company. Maybe that's a hidden gem.
So for a growth investor, a PE of 6 might be a turnoff. But for a value investor looking for bargains, it might be intriguing.
Exactly. It depends heavily on the industry, the company's specific situation, and the investor's strategy. But it provides a quick gauge of market sentiment relative to current earnings.
Okay, for investors focused on income rather than just growth, dividends are key. What does the dividend payout ratio tell us about how much of the earnings are being returned directly to shareholders?
The dividend payout ratio measures exactly that. It's calculated as cash dividends net income. It indicates the percentage of a company's current earnings that it's paying out to shareholders in the form of cash dividends.
Is there another way to calculate it? Maybe using per share numbers?
Yes, an alternative and often simpler way, especially if you already have EPS, is dividends per share, earnings per share. It gives the same result. This ratio is important because it reflects the company's dividend policy. A low payout ratio might mean the company is retaining more earnings to reinvest back into the business for future growth. A high ratio means less is being retained for growth, but shareholders get more immediate cash return.
Let's calculate it for G Company in year two. Net income is $200,000. The notes say they paid a cash dividend of near 80 cents per share, and that there were 100,000 shares.
Okay, so total cash dividends paid equals $80,000, 100,000 shares equals $80,000.
Right.
So dividend payout was $80,000, near $0 to 0.40 or 40%.
Alternatively, using per share data, dividends per share, earnings per share $2, $0 and 40%, same result.
Exactly. So G Company paid out 40% of its year two net income as dividends to its common shareholders, retaining the other 60% within the company, presumably for reinvestment or strengthening the balance sheet. Finally, within these performance metrics, let's quickly revisit asset turnover. We saw this earlier as part of the DuPont ROA calculation. The formula is sales net average total assets.
Right. Sales divided by average assets, we calculated it as 0.65 times for G Company. Why bring it up again here under performance?
Just to reiterate its importance as a standalone indicator of operational efficiency, it directly measures how effectively a company is utilizing its asset base to generate sales revenue. A high asset turnover ratio signifies that a company is getting a lot of sales mileage out of its assets, which is generally a sign of good performance. G Company's 0.65 is, as we noted, relatively low, suggesting they might be asset heavy or not generating as much revenue from their assets as they potentially could compared to more efficient companies. It's a key lever for overall performance.
Wow. Okay, that was a huge amount of information and insight we managed to pull just from calculating and comparing these ratios for G Company. They're clearly powerful tools. But, nothing's perfect. So what are some of the caveats or limitations we should be aware of when we're using these ratio analysis tools?
That's a crucial point to raise. While ratios provide immense insight, they absolutely do have inherent limitations, and it's vital to keep these in mind. Probably the most significant is data reliability.
Meaning the numbers themselves might not be perfect.
Exactly. Ratios are only as good as the underlying financial statement data they're based on. And financial statements, while audited, often involve estimates like estimating bad debts, historical costs, which might not reflect current value, or fair value judgments, which can be subjective. Different accounting methods allowed under GAAP or IFRS, like different inventory valuation methods, FIFO versus LIFO, or depreciation methods, can also impact the reported numbers and thus the calculated ratios, making comparisons sometimes tricky.
So garbage in, garbage out, potentially, or at least slightly skewed data in, slightly skewed ratio out.
Pretty much. You need to be aware of the accounting policies used and any significant estimates involved. Also, and this is really critical, ratios should not be used in isolation.
We've touched on this comparing to industry or history, but you mean even beyond that?
Yes. Ratios are powerful tools for analysis, pointers, indicators, but they do not provide the full picture on their own. You need additional context, qualitative information about the company, its industry, its management, the economic environment. All of that helps you interpret the ratios correctly. A single ratio might tell you what is happening, but it rarely tells you why it's happening, or if it's just a temporary blip or part of a sustainable long-term trend.
So don't just calculate a ratio and jump to a conclusion. Use it as a starting point for deeper questions.
Exactly. Use them to identify areas that warrant further investigation.
Okay, so if ratios aren't the whole story, what other analytical methods can we use alongside them to get that fuller, more complete picture? What complements ratio analysis?
Excellent question. Two very common and powerful complementary techniques are horizontal analysis and vertical analysis.
Horizontal and vertical. Okay, what's horizontal analysis?
Horizontal analysis, also known as trend analysis, Measures the dollar amount and or percentage change of individual financial statement items over a period of time, typically year over year or maybe over 3 to 5 years.
So looking sideways across the columns of comparative financial statements.
Precisely. You calculate the change from year one to year two for things like revenue, COGS, net income, specific assets, etc., both in absolute dollars and as a percentage increase or decrease. This is incredibly useful for identifying trends. Is revenue growing consistently? Are certain costs ballooning? Spotting significant changes that need explanation and understanding the overall direction the company is moving in.
Like seeing if sales grew 10%, but marketing expenses grew 30%. That would raise a question.
Exactly. It helps you see the dynamics over time.
Okay, that's horizontal. What about vertical analysis, looking up and down?
You got it. Vertical analysis, also known as common size analysis, converts all financial statement items to a common size, expressed as a percentage of a key base figure. For the income statement, every single item, like COGS, gross profit, operating expenses, net income, is expressed as a percentage of total sales revenue for that period.
So sales is 100% and everything else is shown as a percentage of that.
Right. And for the balance sheet, every asset, liability, and equity item is typically expressed as a percentage of total assets for that same period.
Total assets is 100% and everything else is a piece of that pie.
Yeah.
Why is this useful?
This common size format is incredibly powerful for two main reasons. First, it facilitates period-to-period comparisons for the same company. You can easily see if, say, the cost of goods sold as a percentage of sales is creeping up over time, even if absolute sales are growing. It highlights changes in the structure of the financials. And second, perhaps even more importantly, it allows for direct comparability among different companies, even if they are vastly different in absolute size. By reducing everything to percentages of a common base, sales or total assets, you can compare the financial structure and performance of a huge corporation directly against a much smaller competitor in the same industry. It puts them on a level playing field.
That makes total sense. It removes the distortion of size. It's like looking at all companies through the same magnifying glass, focused on proportions rather than just big numbers.
Exactly. So using ratios, horizontal analysis, and vertical analysis together gives you a much richer, multidimensional understanding of a company's financial health and performance than any single method alone.
Ratios for the snapshot and key indicators, horizontal for the trends over time, and vertical for the internal structure and cross-company comparisons. That's a really comprehensive toolkit for financial detective work. Okay, we've spent a lot of time using ratios and comparative analysis to understand what happened, historically, looking at G companies' financial statements. Now, let's shift gears to something different. Variance analysis. What is this, and how does it help a company, particularly with internal management and control? This feels like it's more about figuring out why did things happen compared to our plan.
That's a perfect way to frame it. Variance analysis is a really powerful management accounting tool used primarily for comparing actual performance to some predetermined benchmark, usually a plan, a budget, or perhaps an engineered standard. Its main purpose is for planning and control within the organization.
Planning and control.
By systematically comparing actual results, revenues, costs, to what was budgeted or expected, management can evaluate performance, identify areas where things went significantly better or worse than planned, and then, crucially, investigate the causes of those variances to take corrective action or update future plans. It provides the first and most basic level of control and evaluation of ongoing operations against the annual business plan.
So it's about spotting deviations from the plan and figuring out why they happen.
Exactly. Now, to really understand variance analysis, especially for costs, it's important to quickly refresh the difference between variable costs and fixed costs.
Okay, variable costs change with volume, fixed costs don't.
Pretty much. Variable costs, in total, change in direct proportion to the level of production or sales activity. Think of the raw materials needed for each unit produced. If you produce twice as many units, you'll use roughly twice the amount of material, and the total material cost will double. The cost per unit stays constant, but the total cost varies with volume.
Got it. More activity, more total variable cost.
Right. Fixed costs, on the other hand, remain constant in total, regardless of the level of production or sales, at least within a certain relevant range of activity. Rent for the factory building, the factory manager's salary, straight-line depreciation on equipment, these costs typically don't change whether you make 1,000 units or 2,000 units in a month. The total cost is fixed, but the cost per unit actually decreases as volume increases because you're spreading the same fixed cost over more units.
Okay, variable total changes, fixed total stays the same within reason.
Right.
That distinction seems key for variance analysis.
It is absolutely key. And one other term that's central here is the contribution margin.
Contribution margin.
With that, it's simply revenues, or sales, all variable costs. It represents the amount of revenue that's left over after covering all the variable costs associated with generating that revenue. This remaining amount is what contributes towards covering the fixed costs and then hopefully generating an operating profit. It's a really important concept for understanding profitability at different activity levels and for making decisions about pricing or whether to accept special orders. Hashtag 7.2 Basic Performance Report. Neostar example 1.
Okay, concepts down. Let's look at a concrete example. We're shifting from Guy Company to a new fictional company, Neostar Corporation. They made a budget, but as often happens, things didn't go exactly as planned. I see a basic performance report here comparing their budget to their actual results.
Exactly. Let's set the scene. Neostar Corporation had budgeted to sell 10,000 units of their product at a price of $15 per unit. They expected variable costs to be $12 per unit, meaning a contribution margin of $3 per unit or 20% of sales. Their fixed costs were budgeted at $25,000, so their budgeted operating income was $5,000.
Okay, that was the plan. What actually happened?
Well, the reality was a bit different. They only managed to sell 8,000 units. Their actual revenue came in at $112,000. Actual variable expenses were $100,800, and actual fixed costs were $24,000.
Okay, let's look at the variances in this basic report, the difference between budget and actual.
Right, the report shows revenue, budgeted $150,000, 10K units, $15, actual $112,000. That's a difference of $38,000, and since actual is lower, it's shown as $38,000. Unfavorable variance, a significant shortfall.
Ouch. Variable expenses, budgeted $120,000, 10K units, $12. Actual $100,800. The difference is $19,200. Since actual expenses are lower than budget, this is shown as a $19,200 favorable variance.
Favorable. Okay, on the surface, that looks like good news, right? They spent less on variable costs than planned. On the surface, yes. Hold that thought. Contribution margin. A budgeted $30,000, 150K, 120K. Actual $11,200, 112K, 112K, 108K. The variance is $18,800, unfavorable. The drop in revenue far outweighed the favorable variable cost variance. Fixed costs. Budgeted $25,000, actual $24,000. Difference is $1,000. Actual is lower, so that's a $1,000 favorable variance. They managed to save a bit on fixed costs. Operating income. Budgeted $5,000 profit, actual $12,800 loss, $11 SUK, CM 24K FC. The total variance is $17,800, unfavorable. They ended up with a substantial loss when they'd planned for a profit.
Okay, so the overall picture is bad, a $17,800 unfavorable swing from plan. But looking at the components, my eye immediately goes back to that $19,200 favorable variable expenses variance. That looks like a bright spot, doesn't it? Like maybe they were really efficient with materials or labor. But the description under the table here says, and I quote, "Something is very wrong at Neostar, but what?" This seems to be the classic problem with these basic static variance reports, right? They tell you what the total difference was, but maybe not why, and that favorable variance might be misleading.
You've absolutely hit on the core limitation of a basic or static performance report like this one. It compares actual results at the actual activity level, 8,000 units, directly to the original master budget based on a different activity level, 10,000 units. Variances that arise, particularly seemingly favorable ones, like the variable cost variance here, can be incredibly misleading without deeper analysis.
Why misleading? They spent less.
They spent less in total, yes, but think about why. They produced and sold 2,000 fewer units. Of course, their total variable costs were lower than the budget for 10,000 units. That $19,200 favorable variance is largely, maybe entirely, just due to the lower volume, not necessarily because they were more efficient per unit.
Ah. So it's not necessarily an efficiency saving. It's just they did less stuff. So the costs that vary with stuff went down.
Exactly. And look closer. Neostar's budgeted contribution margin ratio was $315, 20%. But their actual contribution margin ratio was only $11,200. Actual CM, $112,000. Actual revenue equals 10%. That's a huge drop in profitability per dollar of sales.
Wow. Yeah, cut in half.
And remember, sales in units were off budget by 2,000 units, which is 20% lower, 8K versus 10K. Yet revenue was down from 150K to 112K, which is a drop of 38K, or about 25%.
So volume down 20%, but revenue down 25%. That doesn't quite track, does it? It suggests their average selling price must have been lower than the planned $15.
Precisely. If they'd sold the 8,000 units at $15, revenue would have been $120,000. Since it was only $112,000, their average selling price must have been 112,000. 8,000 units equals $14 per unit. They were $1 per unit lower than planned.
Okay, so this basic report hinted at problems, but it's messy. The favorable variable cost variance hid potential inefficiency, and the revenue variance mixed up the effect of lower volume and lower prices. We know there's a problem, but we don't know the root causes clearly, or where management should focus their efforts to fix it. Tag 7.3. The power of flexible budgets. Neostar example 2.
Exactly. And this is where the true power of flexible budgets comes into play. This is where variance analysis gets really insightful and useful for managers.
Flexible budgets. Okay, what makes them flexible?
A basic static budget, like the one we just looked at, is prepared for only one planned level of activity, 10,000 units for Neostar. But in the real world, actual activity levels often differ. A flexible budget is designed to adjust for these differences in actual activity levels. It provides a far more meaningful comparison because it essentially recalculates what the budget should have been for the actual level of output achieved.
Ah, so it bends or flexes to match the actual volume.
Exactly. By doing this, it isolates the impact of simply selling more or fewer units, which we call volume variances, from other factors like how well prices were controlled, price variances, or how efficiently costs were managed per unit, efficiency or spending variances.
So it's like comparing apples to apples finally.
Yeah.
Instead of comparing the actual results for 8,000 units to the original budget for 10,000 units, the flexible budget says, okay, Neostar actually sold 8,000 units. Based on our original plans per unit, what should their revenues and variable costs have been for those 8,000 units? And then we compare the actual results for 8,000 units to that flexible budget number. That clears things up so much conceptually.
Precisely. That's the core idea. Let's walk through Neostar's Flexible Budget Performance Report, which is designed to break down that total master budget variance of $17,800 into two much more meaningful components: flexible budget variances and sales activity, volume variances.
Okay, I see the columns here: actual results, then flexible budget variances, then the flexible budget itself, then sales activity variances, then the master budget.
Right. Let's build it from the middle out. First, we calculate the flexible budget at actual activity, 8,000 units, based on the original plan. Revenue should have been 8,000 units, 15 unit equals $120,000. Variable cost should have been 8,000 units, 12 unit equals $96,000. Contribution margin should have been $120,000, $96,000, well, $24,000. Contribution margin should have been fixed costs are budgeted fixed, so they remain $25,000. We'll come back to this. Operating income in the flexible budget, $24,000, CM $25,000 FC equals $1,000 loss.
Okay, so if they'd hit their per unit targets but only sold 8,000 units, they should have had a $1,000 loss.
Correct. Now, we compare the actual results at 8,000 units to this flexible budget, also at 8,000 units. The difference between these two columns gives us the flexible budget variances. These variances tell you about efficiency and pricing performance at the actual volume achieved. They strip out the effect of just selling fewer units.
Yep. Okay, let's look at those flexible budget variances for Neostar. Revenue. Actual $112,000 was flexible budget $120,000. That's $8,000. Unfavorable. Variable costs. Actual under $1,800 versus flexible budget $96,000. Actual is higher than it should have been for 8K units, so that's $4,800. Unfavorable. Contribution margin. Actual $11,200. Flexible budget $24,000. That's a total of $12,800. Unfavorable from these operational factors. Fixed costs. Actual $24,000, budgeted $25,000. Actual is lower, so that's still $1,000 favorable. This is a spending variance on fixed costs. Operating income. The total flexible budget variance is $12,800 from CM plus $1,000 from fixed costs, $11,800. Unfavorable. Wow. Okay, this is telling a very different story than the basic report. That $8,000 unfavorable revenue variance must be purely due to the lower selling price. $14 actual versus $15 planned. Right. Because volume is held constant here. Exactly. That's the unfavorable sales price variance that confirms they discounted. And the $4,800 unfavorable variable cost variance, the basic report called variable cost favorable. But this flexible budget comparison shows that for the 8,000 units they did make, they actually spent $4,800 more than they should have based on the planned $12 per unit. This points to actual inefficiency.
Precisely. Their actual variable cost per unit was $100,000, $8,000 units equals $12.60. They spent 60 cents more per unit than planned. That's the unfavorable variable cost spending or efficiency variance. The flexible budget isolates it.
This is so much clearer. So the flexible budget variances total $11,800 unfavorable, reflecting poor pricing and poor cost control for the volume they did achieve, slightly offset by saving on fixed costs.
Now let's look at the other piece, the sales activity volume variances.
Yeah.
This is the difference between the flexible budget at actual activity, 8,000 units, and the original master budget, 10,000 units. This variance tells you the impact solely due to the difference in sales volume, the impact of selling 2,000 fewer units than planned.
Okay, how does that break down? Revenue. Flexible budget 120K versus master budget 150K. Difference is $30,000. Unfavorable. Selling 2,000 fewer units at the planned $15 price cost them $30K in revenue. Variable costs. Flexible budget 96K versus master budget 120K. Difference is $24,000. Favorable. By not making those 2,000 units, they avoided $12 in variable cost per unit, saving 24K. Contribution margin. Flexible budget 24K versus master budget 30K. The difference is $6,000. Unfavorable. Each unit not sold cost them $3 in planned contribution margin, 15 to 12. So 2,000 unit, 3 unit under 6,000 lost contribution margin due to lower volume. Fixed costs. No volume variance here as they are fixed. Operating income. The total sales activity variance is thus $6,000. Unfavorable. Okay, let me see if I've got this. The total difference from the original budget was $17,800, unfavorable. The flexible budget analysis breaks this down into two parts. $11,800 unfavorable due to flexible budget variances, bad pricing, bad variable cost control, slightly offset by good fixed cost control, plus $6,000 unfavorable purely due to selling 2,000 fewer units than planned, and $11,800 plus $6,000, $17,800. So it balances perfectly.
Exactly. That's the beauty of it. The flexible budget framework neatly decomposes the total variance into components that tell management why the overall results differed from the plan.
This is brilliant. It really helps managers know where to look, as the notes say. The initial report was confusing with that big, favorable variable cost number, but the flexible budget revealed that actually their variable cost per unit was higher than planned, the $4,800 U flexible budget variance, and they cut prices significantly, the $8,000 U flexible budget variance. The only reason total variable costs looked favorable was the huge drop in volume.
You've nailed it. Instead of management maybe patting themselves on the back for controlling variable costs based on the static report, the flexible budget directs our attention precisely where the problems lie. Why was our selling price $1 lower than planned? And why did each unit cost us $60 more in variable cost than planned? It also quantifies the impact of simply not hitting the sales volume target.
So Neostar management now knows they need to investigate their pricing strategy. Were the discounts necessary?
Oh,
And the production efficiency or input costs? Why were variable costs per unit higher? They also know the separate financial impact of the sales shortfall itself. This is incredibly actionable intelligence compared to the first report.
That's the power of flexible budgeting and variance analysis. It transforms a vague "something is wrong" into specific, measurable areas requiring management attention and targeted corrective actions. It helps understand the why behind the what. Hashtag, outro promise.
Wow, okay, that was genuinely a deep dive. We started with what can feel like really dry numbers, complex formulas, maybe intimidating financial jargon, but we've ended up with actually a really powerful set of diagnostic tools. It really does feel like having X-ray vision for looking inside a company's performance and health.
Indeed. I hope we've shown that financial ratios, when used thoughtfully, provide that crucial snapshot of a company's health, quickly revealing its profitability, its liquidity, its solvency. They let you understand, at a glance, if a company is making money, if it can pay its immediate bills, and if it's built on a stable foundation for the long term.
Yeah, the ratios give you the what. And then variance analysis, especially with the elegance of flexible budgets like we saw with Neostar, helps pinpoint where things might have gone off track compared to the plan. It moves beyond just knowing you missed the budget to really understanding why you missed it, separating out issues of sales volume from issues of operational efficiency or pricing decisions.
And these tools, when you get comfortable with them, they offer incredible insight for any curious learner. It doesn't matter if you're formally analyzing a potential investment, or maybe assessing a business partner, or even just trying to make better sense of the financial world that's reported in the news around you.
You really can start to see the trends, spot the strengths, and identify the weaknesses hidden within a company's financial story.
yeah.
It stops being just a jumble of numbers and starts becoming, like you said earlier, a living, breathing narrative of a business.
That's the goal.
So, to wrap up, here's maybe a provocative thought for you, our listeners, to chew on. Think about the companies you interact with every single day. Maybe it's your favorite local coffee shop, or maybe it's a huge global tech giant whose products you rely on. How might understanding just a few of these key ratios, maybe their profit margin, their quick ratio, their debt to equity, how might that change your perception of their success, their stability, or even their future prospects? What story do you think their numbers might be telling, and what questions would you start asking if you could see them?
It's a great exercise. Keep digging, keep learning,
Yeah.
and most importantly, always keep asking, what does this really mean? Because the numbers are always talking if you just learn how to listen.